Okay, welcome to the November 7th Fats, Fuels, and Oils webinar. This week's going to be a little bit different. I got the flu over the weekend and was out yesterday and was kind of out today. I was actually going to cancel this and then realized that we'd gotten within the hour, and so didn't want everybody to show up and me just not to be here. So one, that means that none of the forecast stuff is updated, but I'm going to try and get that updated tomorrow. And two, what we'll talk a little bit about today basically is what's going on in the market. And then we will run through expectations for tomorrow's WASDE report, since I can actually kind of show you that in the spreadsheets and have something to talk about. And then if you have any questions, today will probably be a shorter webinar. So if you have questions, today will be a good day for questions. Okay, so what's going on in the markets? There still is concern about Argentine dryness, and I think that that's probably one of the bigger concerns really right now. We're still ahead of when Argentine farmers would begin planting soybeans, but that window is kind of rapidly closing, and the iterative versions of the ENSO forecast, which is the forecast for sea surface temperatures in the Eastern Pacific Ocean, to determine whether we're in El Nino or La Nina, have kind of extended the period of the La Nina, or delayed when the transition from La Nina to neutral or neutral to El Nino is expected to occur. And they've done that in part because sea surface temperatures have just remained colder than the models had predicted. And so I think it's one of these situations where the models really want to start the transition, but the initial data that they use in the models has been lower than each month. It's been lower than what the previous month forecast for that month. And so that is a little, I guess, troubling for the forecast going forward, because it's a little difficult to tell whether the model is just misreading something, or whether it's just kind of a little bit of a delay in when the transition was expected to begin. But now the La Nina is expected to persist through the winter months in the US, and some of the models would suggest that we may not get to sort of the real sort of El Nino, La Nina neutral or ENSO neutral temperatures until April or May, which would be basically all the way through the South American growing season. So far, it hasn't seemed to have had a huge impact on Brazilian weather, and that seems to be doing okay. But the Argentine weather has not been super supportive for early planting or corn planting, which is where we are kind of in their season right now. We don't have to get back to neutral for weather conditions to improve. I think as that swings from La Nina towards neutral, then that there's a chance for better chances for rain. And it hasn't been completely dry, and the forecast suggests that there will be some rain in Argentina over the next week, I believe. It's been a little while, honestly, since I've looked at the forecast maps. And so that rain, what might happen around that rain is that farmers take advantage of that and start to plant soybeans a little bit earlier than they would normally, although there have also been farmers that have delayed their corn planting that probably will want to try and get their corn crop in the ground around that rain and then wait for the next rain for soybean planting. The impact really on the market is relatively minimal if the Argentine crop is just kind of 5 million tons or even 10 million tons smaller than it's expected to be. So if expectations are kind of around 150 million ton, or sorry, 50 million tons, and the crop comes in at 40 million tons, that's a big deal, especially if you're an Argentine farmer. But if the Brazilian production is close to what's expected right now, then that really minimizes any impact that drier weather can have in Argentina. Now, obviously, there's some chance that if La Nina persists, that the Brazilian weather won't be optimal, and people will start to cut their forecast from 150 million tons of soybeans in Brazil down to something lower, and then whatever that is, plus the impact in Argentina would have a more significant impact. But at least right now, we're not at that point yet, and it's still really early in the growing season, and so there's lots of time for things to change, and even potentially for the La Nina forecast to change and accelerate the transition so that we're back to sort of where we were several months ago with that forecast. The other thing I think that's happening in the markets is that we got the fats and oils data, and that came in pretty much as expected, or within the range of the difference between the difference between the numbers suggested by the NOPA report and the fats and oils report were generally within the range of recent history anyway. And specifically, sort of if you look at the difference in soybean oil ending stocks, which is part of what sort of helped support the market through this last rally, that came in pretty much right exactly where, if you kind of took the average of the difference over the last 6 months or so, about right where that would have suggested. And that left 21-22 US soybean oil ending stocks just below 2 billion pounds, which is not really, it's just kind of, if we think about sort of 2 billion pounds is the line where above 2 billion is kind of a little bit bearish and below 2 billion is kind of a little bit bullish, in very, very simple terms, obviously. That's really kind of neutral for soybean oil. However, I think that the other thing that the rally did is that it has not necessarily scared, but it certainly has made a lot of biofuel producers more interested in extending their coverage a little bit. My kind of theory on this was that as soybean oil prices came down and energy prices remained relatively high and margins really widened out, that biofuel producers had the opportunity to kind of wait and see what the market would do before they needed to make any moves. They didn't really necessarily need to extend their coverage when prices were low, because again, they were making so much money and not so much money, like that doesn't quite sound right, but they were making really good margins. And so if prices moved up a little bit, they were still making really good margins, just not quite as good as they were while prices were a little bit lower. And so they had time to kind of wait and see what the market would do. And they did wait. It seemed like, just based on anecdotally what we hear from talking to people, but they've started to get a little bit more aggressive with their coverage in the last week or two, and that has had the has had an impact, I think, on the refining margin and cash basis and that kind of thing a little bit. But I also think that at least part of the rally was sort of speculatively driven. And the reason that I say that is because if you look at soybean oil spreads in the futures market, soybean oil spreads kind of ran up with the rally in soybean oil prices, and the spreads kind of tell you whether the market thinks that the current month or we need more soybean oil now, or we can sort of wait for it. In the extreme, obviously, there's a carry in the market because it costs money to store the commodity, and so deferred futures are generally higher than nearby futures. When the market says that we need more soybean oil now, then it's the opposite, and nearby futures are higher. So the break in the spreads, even though they still are really high relative to what sort of full carry would be, or really high relative to history, but that break tells you that one of two things: either the current market is well supplied and we don't need to pull supplies forward, or that there has been a little bit of speculative excess in the market, and as the spreads break, a little bit of that speculative excess comes out. I think that's probably what's going on today. And I think I said last week that, while I don't really expect that the prices are going to run right back down to 65 cents, that I thought that the downside risk was larger than the upside risk at that point. Now, in all fairness, I think that was probably a couple of cents ago, so not exactly really super 100% clear. The market didn't turn the day that I said that, unfortunately. But I think that dynamic is still in play. And if that is true, and the market starts to come back down a little bit, I think the impact on biofuel producers will be that they probably will take a little bit of a step back and kind of see whether prices will move down or not. Now, again, I think they're still making relatively good margins, or really good margins relative to history. And so locking in prices right now doesn't necessarily mean that, if prices go down a little bit, that they're going to be, obviously the buyers will be disappointed because average price is what they're judged on, but it's not going to be like in terms of profitability that they're going to have missed a huge opportunity to be profitable relative to where prices were. And so I don't know that I think that they'll step completely back, because there is this concern about maybe South American growing season doesn't go as well as expected. But I do think that there's some chance that if prices kind of move a little bit lower, or at least quit going up, that they won't feel the need to be as aggressive in extending their coverage as I think that they have been over the last couple of weeks. Outside of that, I think there's still some uncertainty about the grain corridor and exactly what's going to happen with Ukrainian sunflower oil exports. I think Russia at one point said that they weren't going to extend the agreement, and then I think they came back and said that they were going to extend the agreement, and it may be that since then they've changed their mind again. Whether they choose to extend it or don't choose to extend it, I think that there's enough uncertainty there that there's going to continue to be some premium in world vegetable oil prices, just based on the idea that that not all of the supply that could potentially be sourced from Ukraine is going to be sourced from Ukraine. And even if the grain corridor is extended, Russia attacked a lot of the infrastructure in Ukraine In particular, they attacked a lot of the power grid infrastructure in Ukraine. And so it's not like they had an abundance of electricity before the attacks, and there were concerns about how much Ukrainian crushers would be able to crush and export before the attacks, and the attacks obviously did not improve that situation. So I think that ultimately, I think that the market's going to need to adjust to the idea that that probably you're not going to get as much sunflower oil out of the Black Sea as we thought maybe several months ago. But it's also not going to be a complete loss, that it's going to be more sort of, again, kind of exporting seed to Europe, having European crushers process it, and then exporting sunflower oil out of Europe. Of course, there are also, again, concerns about the electricity supply in Europe, and natural gas supplies not being able to necessarily support European crushers in a way that would allow them to crush more seed than they would just from the European crop. But I don't think that those losses will be that significant. I think probably if you think about just sort of the Ukrainian crop and pretend there's no war, how much do they export in sunflower oil, and then what is going to be exported in sunflower oil now out of Europe and out of Ukraine. There's obviously going to be some loss, but it's not going to be certainly not what everybody feared at the beginning of the war, and not probably not as bad as some of the more dire predictions or dire thoughts right now, because again, they can kind of export the sunflower seed out to Europe and get some of that crushed, and then in theory are going to be able to export sunflower oil out of the Black Sea. Although if you look at the Ukrainian agricultural ministry has a really nice web page that kind of shows the change in transportation modes. And it goes from obviously the vast majority of exports by sea to, I think it was roughly 50-50 a month or two ago, the most recent data as of a couple of weeks ago anyway. And so maybe that changes a little bit, and the sea part drops down below 50% to 40% or 30% or whatever it drops down to. And again, you export more sunflower seed over land and then sunflower oil out of Europe. Outside of that, I think the other big question, and again, this isn't necessarily a vegetable oil question, but it's something that's going to have a big impact on the oilseed complex, is Chinese demand. And I can't remember whether I talked about this last week or not, so I'll go through it again. And if I did talk about it last week, I apologize for the repeat. But I think what a lot of us thought sort of over the past year or so was that as China's hog industry recovered from the African swine flu or African swine fever, that the government was using that to transition from an industry that had a lot of very small farms, and by very small farms, I mean sort of 3 or 5 hogs in the backyard that basically ate table scraps and whatever else was kind of around, to one that was as modern as the US industry, or in some cases even more modern. If you've seen sort of the pictures of the hog hotels, they're kind of these huge multi-story facilities that is where the Chinese industry is going to go to. And that transition would necessarily mean that the soybean meal consumption per hog was going to go up, because instead of feeding 3 to 5 hogs in the backyard table scraps, most of the hogs would be fed a ration that was manufactured. And because of that, Chinese soybean import demand would go up in line with soybean meal. And what we really saw last year is that not only did that sort of not happen, but Chinese soybean imports were significantly below most expectations headed into the year. And so the question becomes, what do Chinese imports look like in the coming year? And whether the 22-23 total is going to look more like last year or going to be sort of along the trend line that you could draw from kind of the ASF lows out a year and then extend it on to the next year. If it's going to look more like it did last year, and you get a good South American crop, then I think it's easy to cut U.S. exports, U.S. soybean exports, which means that soybean prices probably have room to move lower, and then the complex prices would come down with them. If Chinese demand is really strong, we don't have a South American crop, then obviously the exact opposite occurs, and soybean prices move higher or maybe significantly higher. And you can sort of imagine that soybean oil and maybe soybean meal kind of go with soybean prices, and we could get a situation where we relatively easily take out last year's highs, or the highs that were set sort of last spring in soybean oil. I don't think it's going to be that one. I'm leaning more towards the not quite as bad as last year in terms of Chinese soybean import demand, maybe a little bit better than that, but also they can source a fair amount of the soybeans that they need out of South America. And so there's room to cut US exports, but you don't need to necessarily cut them really, really aggressively. And that to me means that, okay, maybe soybean prices go down a little bit, and that leaves soybean oil to kind of continue to trade around the range that it has been in, call it 65 to 75 or so. And whether we're at the lower end of that range or the upper end of that range depends on exactly where the South American crop sort of comes in. If Argentina is 10 million tons short and Brazil is 5 million tons short, then we're probably, again, maybe in the middle of that range. The more that you start to take out of either country, but more importantly, the more that you start to take out of Brazil, the higher soybean prices go and the higher soybean oil prices go. All right, with that, let me share this, and I apologize, this is going to be a little busy because we're going to look at spreadsheets instead of usual stuff. All right, so this is the soybean oil supply and demand balances and USDA's October report numbers. So you can see for 21-22, we basically have all of the data except for biofuel use is the only thing really that we don't have data for. So USDA is probably going to need to cut production a little bit, imports basically about the same, and raise exports a little bit. Now, unfortunately, this actually isn't the real export number just because I didn't get the last month's data in there yet. I raised it up based on the export sales number, so I apologize, but I'm not 100% sure whether USDA is going to need to raise a little bit or raise a little bit more than their September number, I guess. either way, the ending stocks number is going to come in here at just under 2 billion pounds. And so that means that they'll have to cut it a little bit. Not huge changes to 21-22, which is very typical for this time of the year. For 22-23, USDA is not likely to make a lot of significant changes just because we're at the beginning of the marketing year, and so any changes that they make probably will look a lot like the changes that they made in September, where maybe a change in their crush forecast makes them change their production forecast, and then to the extent that that is significant, which I don't think it would necessarily be, but to the extent that they made a significant change in their crush forecast and that had a big change in production, they would probably make some changes to their domestic demand to offset at least part of that change. Now, you can see the big difference between our outlook and USDA's September outlook is in production, and that is due in part to a pretty significant difference in crush. You can see the crush number here. So we're 40 million bushels above where USDA is in their crush, and the NOPA data for October will be a good indicator of sort of where we are going to go in crush during the year. Now, obviously, October is still really early in the season, but September came in not super low relative to history, but a little low relative to where you would want it to be if you're going to set a record in crush. And that was, if October is going to follow that up with another month of below expected crush, even though crush margins remain really at the upper end of the historical range, then we probably will temper our crush. We will start to temper our crush expectations a little bit. It may be that right now the demand for soybean oil isn't as strong as it will be later in the year, and so it may be that crush is a little bit weaker at the beginning of the year than you would expect, given whatever the final number is, and a little bit stronger at the end of the year relative to sort of that typical seasonal pattern based on the marketing year total. So I probably, even if the October number is weaker, I probably won't be really aggressive about cutting. And even if it's a little bit weaker, I don't know that it necessarily means that USDA would necessarily cut it. They wouldn't. The NOPA report comes out after the WASDE report, obviously, so they wouldn't have a chance to react to the NOPA data until next month's WASDE. But even then, I'm not sure that they would necessarily cut their crush forecast that much if it's a little bit weaker, just again, based on sort of the expectation that because of the growth in renewable diesel capacity, that feedstock demand is going to continue to grow, and eventually we're going to need to crush a volume of soybeans that supports the soybean oil demand. Outside of that, you can see, outside of the production numbers, you can see we're basically offset most of our higher production with higher biofuel demand. Our export numbers a little bit lower, and our ending stocks are just a little bit higher. Now, in addition to our higher crush, one of the numbers that is bigger is this number right here, this 11.81, which is our forecast for the marketing year average yield in soybean oil. And I know yield is a little bit down in the weeds and not something that I think is top of the mind for most people, and not that it should be top of the mind for most people, but you can see our number is 11.81, USDA's is 11.62. And you can see where we were the last 2 years. We were 11.84 and 11.73. Again, part of the yield depends a lot on weather conditions during the end of the growing season. If it's cold and wet, you tend to get less oil per seed, and if it's warm and dry, you tend to get more oil per seed. We were relatively dry to end the season, and temperatures weren't necessarily well above average, but we weren't well below average for sure. In addition to that, given where soybean oil prices are, I still think that crushers are doing everything that they can to optimize for soybean oil production. And so I tend to think that USDA probably will end up raising their yield forecast as we go through the year, and that will also make up some of the difference on the production side. But again, don't necessarily expect a lot of big changes in our forecast from the USDA for 22-23. I guess the other big thing to note is sort of our average price forecast, 76.5. I think that probably is a little optimistic. One of the things, again, that I'm sort of trying to figure out, you'll note that that's the price for Decatur crude, is again this split of the RBD basis and how much of that ends up being sort of because due to refining margin, and how much of it ends up being based on crude basis, and what that total number actually is. And so the 76.5 really is kind of reflective of relatively high basis for crude soybean oil. I don't, off the top of my head, I don't know what the average is for the year, but I know that if you look out through the year, that the crude basis gets up to 8 or 9 cents, somewhere in there, maybe even a little bit higher than that. And so that 76.5 cents really kind of implies probably futures around 65 cents, maybe a little bit higher than 65 cents, just to put it in context of the futures market right now. All right, on to canola. For canola supply, again, we'll get to the same kind of thing for 21-22, with USDA kind of truing up based on the data from the fats and oils report. I think one thing that was kind of surprising to me in the fats and oils report was the canola oil ending stocks jumping up to 174. That was well above. That was 35 or 40 million pounds above where we were expecting ending stocks to be. And so I think that that probably is more reflective of the fact that canola crush is recovering from the drought the year before, and so canola crushers have really been going, and there's just some more stocks around because there's probably more supply around than there has been. And I think that that's due to the I think that's why stocks are higher, not necessarily because canola demand is down or not down. One of the key things I think for the next year will be the change from 21-22 to 22-23 in non-biofuel. And you can see that we've got a relatively large increase in non-biofuel. We've got biofuel actually coming down a little bit, but that's only because I haven't had a chance to go back and revise that. I don't really expect biofuel demand to go down, especially given the fact that the RIN pathway is going to be approved. And so I would anticipate that we probably will end up with a number that is close to this year's number, which is, we estimated it's sort of just south of 1.4 billion pounds. So we'll probably end up in the 1.4, 1.45, maybe even 1.5 billion pounds of demand. That won't necessarily eat into our non-biofuel. What it will do is it will probably raise our import forecast, and that will depend a lot on where Canadian production is and the Canadian crush is. I probably will also take the stocks number down. I'm not sure how that stocks number got to 382, but again, obviously I need to go through my canola oil balance sheets and tighten those up a bit, something I would have done yesterday. Okay, so there's not really a whole lot much more to say on canola. I think, I think the theme in canola continues to be the recovery from the drought, good crushing margins, and then again, the open question really is how much soybean oil non-biofuel demand will be replaced with canola oil this year. And if you think back to sort of our soybean oil balance sheet, we've got really relatively strong non-biofuel demand and ending stocks that are still close to that 2 billion pound level. But if biofuel demand is a little bit stronger than we expect, or production isn't as strong as we expect because of lower crush, then again, I think canola is kind of there to step in and substitute for soybean oil. The spread between canola oil and soybean oil narrowing and narrowing more rapidly than we expected kind of makes me believe that is that's going to happen. It's just a question of how much the growth in biofuel feedstock demand will kind of drive the need for substitution from canola oil. As far as prices go, you can see we've got our average price down here about 7 cents a pound in the Los Angeles market. In other markets, in the Midwest market, I think it probably year over year will be down maybe more than that, because while there are a couple of renewable diesel producers in sort of the Mountain West area that probably will use some canola, and it will get used in the West Coast market a little bit, given that the center of production for canola and canola oil is really the Midwest. I think that's where the bulk of the supply obviously is going to be. And so if you sort of monitor canola oil prices in the Midwest and you have an idea of the differential between the logistical differential between the Los Angeles market and the Midwest market, whatever that was last year, I think it's probably a little bit larger this year, so that the Midwest prices would probably drop a little bit more relative to last year than in the Los Angeles market. All right, final one to review here is just the Canadian canola oil supply and demand. Again, we'll probably get a little bit of truing up on the 21-22 data, and then we probably won't necessarily get big changes on 22-23 unless USDA again make some significant change to their Canadian crush forecast. The big difference in our stocks numbers is because we reconcile to a different stocks number than USDA, or I guess more accurately, we don't reconcile to USDA's ending stocks number. We reconcile to the Canadian Canola Association, I think is the source for our ending stocks number. And so that's why you see that big difference. It's more about sort of looking at the year over year change, and they don't expect a big change. They've got a small build, and we kind of are about the same. The one thing the last thing I guess I would note is domestic usage. Our domestic usage number might be a little bit low. Just will depend a lot, like the U.S. kind of on the amount of biofuel demand, both in the U.S. and then in Canada. I guess for domestic usage, a lot of it will depend on. It will all depend on the strength of feedstock demand in Canada. The export number, again, I think if U.S. non-biofuel demand for canola oil is going to be higher, then you could see this export number move up a little bit, although I suspect it's more about rearranging where the exports go than it is about raising that export number in terms of what it actually is going to be. For palm oil, the USDA data for palm oil isn't really that important. And while the MPOB report comes out this week, again, unfortunately, I haven't gone through the MPOB enough to speak intelligently about what expectations are, or where we are relative to expectations. So unfortunately, we'll have to wait until next week, and then I'll kind of review what the MPOB said. All right, with that, I will open it up with questions. I can't believe. Okay. Oil share is currently around 47%, which is similar to last year, or similar to the year ago levels. Do you expect this to go down from here like it did last year, or do you think it can go higher? Oil share is something that has sort of provided a couple of head fakes, and there was a point last year where I thought that if oil share dropped below 45%, that it would be a screaming buy for anybody that wanted to trade it, because I thought that oil share's going to have to go to a level that causes crushers to crush for oil. Since then, we've had some expansion in renewable diesel capacity, and until this last rally, oil share hadn't really kind of kept pace with the growth in renewable diesel capacity, or even with the growth really in soybean oil use in biofuel production. And given the fact that the September crush was a little bit weaker than expected, and maybe the October crush will be too, I think at least right now that the market is saying that there's enough soybean oil around currently. And so I don't know that it's necessarily going to go higher from here kind of in the short term. And I could see a little break. Now, that said, the other side of the argument is that as we head into the end of the year, biofuel production typically ramps up as obligated parties need to meet their individual mandates. And so we could see a real acceleration in feedstock demand over the coming weeks and usage over the next 2 months. And in that case, then maybe you get oil share to pop into the end of the year, maybe after a little bit of weakness right now. I think in the longer term, I think that that it's hard to argue against the idea that at some point oil share is going to need to go to a level that that drives crushers to match their crushing volumes with soybean oil demand rather than with soybean meal demand. I think right now you have a situation where soybean meal demand is kind of strong enough that that crushers can still kind of, in the growth in soybean oil demand hasn't been strong enough to force the hand. So crushers can still kind of match their crushing volumes with soybean meal demand and produce enough soybean oil to meet the market's demand. And so that 47% is kind of the sweet spot where we are right now. But that's with us using 950 million pounds a month, call it, of soybean oil for biofuel production, and then another 1.2 billion pounds a month, call it, of non-biofuel demand. If we go up to 1.2 billion pounds a month of soybean oil demand and keep non-biofuel demand at 1.2 billion pounds, then I think we're going to have to, oil share is going to have to go to a level where the crush is going to be dictated by soybean oil demand rather than soybean meal demand. And then we're going to have to figure out what to do with the soybean meal and cram as much of it into the export market as we can. I think that point is going to come. It's just sort of a question of when. Right now, again, soybean meal demand is being driven in part by a recovery in the poultry flock from the bird flu outbreak last year, which was really severe in the US, and basically kind of steady hog production or pork production. And so as long as that soybean meal demand remains relatively strong, that creates kind of a headwind for oil share to go higher, because crushers will meet that meal demand, and then as long as there's enough that produces enough soybean oil, then oil share doesn't need to go higher. So I think it's when oil share really starts to take off is that point where we kind of grow from, again, where we are now, sort of 950 million pounds of soybean oil a month to 1.2, 1.3 billion pounds, and we don't get an offsetting decline in non-biofuel demand. Whether we excuse me, whether we get that decline in non-biofuel demand will depend a lot on the strength of the economy and really based on food manufacturing demand. And while I think that you can argue that stronger economy means more non-biofuel demand, I think you can also sort of say that I guess I've thought for a long time that meant stronger economy means more people eat out. More people eat out means more vegetable oil demand from restaurants and that kind of thing, and that would be stronger veg oil demand. Now I think that maybe it is the case that actually if you do it, sorry, I'm thinking about this. I'm sorry. I thought the opposite. I'm sorry. I thought weaker economy meant more food, more eating at home. Food manufacturing used more soybean oil. I knew I just had that backwards. Meant more soybean oil, and that as the economy improved, people ate out and restaurants used soybean oil more efficiently than food manufacturers, or didn't use as much per meal, sort of. And so I think that from that perspective, you could say that if the economy slows down here a little bit, that people will eat more at home, and that means that non-biofuel demand will be stronger. I think now I've lost and confused myself. Either way, what I really mean to say is that while if the economy weakens, it doesn't necessarily mean that non-biofuel demand is going to drop off a cliff. I think whether non-biofuel demand remains strong or not will depend a lot more on whether food manufacturers are actually able to pass on the increased costs associated with their inputs than it will on the growth in GDP. So if they can pass those costs along, then I think that non-biofuel demand and consumers can absorb them, then I think non-biofuel demand remains strong. if they struggle to pass those costs along, I think that means that the consumer probably can't quite afford it. And I think that means that that non-biofuel demand probably weakens. And if you get non-biofuel demand to weaken a little bit, that helps offset the growth in biofuel demand. Very long way to go to make that point. And then oil share doesn't necessarily need to go up. So after that really long-winded answer, I think there could be some weakness in oil share in the short term, but given where we are in the year, I don't know that I expect a lot of weakness, just because we would expect feedstock demand to go up in the last couple of months of the year. But then after that, maybe you could see further weakness. Again, it will depend a lot on what the South American crop looks like at that point. But then after that, what you're trying to look for is that inflection point of total domestic demand. And when that total domestic demand gets up around 2.5 or 2.6 billion pounds a month, then I think we're going to hit the point where we're going to need to start crushing for oil, because I just don't know that the soybean meal demand can grow that much over the relatively short period of time. I think between where we are today and where we will be when we get to that 2.5 or 2.6 billion pounds of monthly usage. I think that's probably coming within the next year, and I don't know that meal demand will be able to keep up. Okay, sorry, that was really convoluted. All right, so I will. I'm going to try and get all of the forecasts updated tomorrow, and I'm going to try and write just really sort of quick synopsises about the WASDE report, since I haven't written the articles already. So I'll get the data updated, and then I will try and get the articles up Wednesday or maybe Thursday before I get the articles up. There is a chance that, well, I've got to publish something, otherwise the data won't update. So I'll get something up, even if it's just a very short 1-paragraph article about what the WASDE report said. Okay. Thank you, everybody, for joining us this week. Sorry about the confusion and this week's webinar. I hope that everybody has a great week, and I hope to see you all back here next week.